make sense. All right, sorry guys, hold on. There we go. Hey there, everybody. Good afternoon, good morning, good evening, depending on where you guys are at. I hope y'all are having a good trading day so far. Hey, Mirza, Turbo, Chris, great to see you. 007, you as well. Yeah, thanks so much. About last night's webinar, for those of you who may have missed it, let me go ahead and find the replay link and I'll post it out. Basically, for those of you who don't know, I did a joint webinar with both Cody and John Carter talking about small accounts and small account growth. It's a free webinar, so certainly take a look at that if you choose to. I will post the link in here for the replay. There you guys go. And thanks, Chris. I appreciate that. Yeah, it was a lot of fun last night. It was fun doing it with other people instead of just doing it by yourself, if you know what I mean. So let me go ahead and get started. We'll talk about the markets here. A little bit of a shorter session today for us in the free room. So we'll kind of talk about the markets and I'll go over just a couple of things from the webinar last night on what I think is important in growing small accounts and stuff for those of you, or maybe for those of you who have struggled, right? Growing your account, maybe started off big and then it's turned small, unfortunately. I'll talk about some of the reasons why that might, be the case, at least from my own experiences, and the ways that you can hopefully help turn yourself around with it, certainly. Yeah, 007. So one of the stories I told in last night's webinar was about for those of you who don't know, I am a theater major. I have a degree with a BFA in performance. I studied both in the States as well as over in England and Barcelona. Um, and so one of the shows that I did was in the Heidi Chronicles 007. That's what that one was. And I played Heidi in the Heidi Chronicles. A lot of monologues in that show. So I'm still like wondering how I managed to do that. But for those of you who don't know, certainly I'll talk about this in the webinar last night. So if you watch the replay, you'll get it. But in short, what 007 is talking about is I'm pushing out this bassinet, and on one of the last shows that we had, the bassinet legs completely toppled over in the middle of like the stage. And so the reason I told this story is because of course there's a few different ways I could have reacted to that situation, right? The first one, which seems pretty obvious, is you get mortified, right? You get stage fright, you're like paralyzed and what you are able to do, and you just are, you kind of just lose sight of the show. I've certainly seen that happen with other actors in the past, and it's never a fun experience to either witness or to, have happen to yourself. The other situation, of course, that you could do is you get mad, right? You break the fourth wall, start yelling at the stage hands or the props crew, like, how did this happen, right? This should have been checked prior to me pushing it on stage, kind of thing. Of course, blaming everybody else but yourself. And then the last way, or, I shouldn't say the last way, but one of the other ways you could have reacted is you kind of hope from something outside, right? A hope from God, a hopium kind of feel that this will magically fix itself and you can try and carry on with the show. And obviously, that's not going to happen. It's not like the legs will magically start working again in the middle of the stage. And it was clear to the audience, of course, that that wasn't meant to happen, right? It's not like we had a baby cry sound effect that the baby doll started crying whenever the bassinet completely toppled over. But thankfully, due to my trading that I had and that lack of, um, you know, dark side, if you will, the ability to control my emotions, I was very quickly able to just improv, pick up the baby and be like, oh, I said to my fellow actor who was on the stage, the person I closed the show with, I was like, "Oh, don't worry about it. It's cheap. I got it at Walmart." And of course, for anyone who knows about small college towns in the US, if you have ever been to one, you know the only place to shop is at Walmart, right? That's the main shopping point for usually those small towns. And it literally had like the best laugh I have ever gotten. Hundreds of people had a whole bunch of people come up to me after the show saying that was the best line out of the entire show. And so it turned what would have been the most mortifying situation probably in my theater career at that point into something that ended up being really positive. And it was all due to that control of emotions. And the reason why I tell that story is because I think, of course, that's important in life, right? To have a cool and level head, especially in stressful situations. But I think it's very important when it comes to trading. And I think there's a parallel there because the same kind of reaction that you could have had in that moment of stage fright, right? Of that situation occurring to you is the same thing that can happen on your trading. For example, if you're in too much risk, right? And I've seen this happen with traders before. If you have too much capital risk that you put out there, it is very easy to then all of a sudden get paralyzed with fear. Or maybe you've been trading, you've took some big losses, and then you're paralyzed to even jump back into a new trade because you know that negative feeling of taking a loss and you really don't want to take another one, right? But at the same time, you do have to put money out there to play the game of trading. It's just the way it is. And so you might be paralyzed by fear from having had those experiences in the past. You could get angry, of course, right? Why is this trade not working out for me? That emotion can cause you to not stick to your trading plan, to make stupid mistakes. And then, of course, a lot of traders like to trade on hopium when they see a trade start to fall down. Technically, it's breaking, all the chart signals that you had jumped into originally to get into the trade. So, according to a trading plan, most of the time you cut the trade there if it's breaking the technicals off of the original entry. But people don't like to do that. They like to trade off hopium. They'll keep cost averaging a trade. They'll hope that it comes back, from a will of God, if you will, instead of just being unemotional and having that Jedi mind path of, okay, it's not working. I need to cut it and I need to preserve that capital so that way when I find another good setup, I still have money to be able to play. And most importantly, of course, all those negative emotions that paralyze from fear, the anger, right, the hopium, all of those can lead to blowing out your account. And so that's why I ended up telling that story last night because to me it has that really strong parallel of these are all the reactions you could have, right, to a negative situation that occurs. But if you have the level head, if you have the training and discipline to be able to stick to a trading plan, if you really have a good grasp on risk, in my opinion, I think that's personally where all of that stems from is not having a good grasp on capital risk, then it's much easier to survive those moments and be able to jump back into the game of trading. So that is where we're at right now. And absolutely, Nick, we can go over AI. We'll talk about SPX here. And if we have time, of course, if there's anything else that y'all want to look at, please let me know. And I will be happy to pull it up if we still have a chance. But that in short was the story I told. I'm glad it made y'all happy. It was one of the most terrifying moments I think I've had on stage because I didn't say this last night, but in the show I did try once to kind of like fix the bassinet and then it just toppled again and I'm like, this isn't gonna work. I can't I can't I can't spend my time here on stage trying to fix this prop that is clearly failing me. So thankfully I had that quick thinking of Walmart and it just the only note I got on that was one of my professors at the time, he was like a stickler dramaturg, which for those of you who don't know, dramaturgs are basically the ones who like check feck everything. So that way, if you're like in a period play or something like that, they'll, make sure everything's in accordance to that time period and make sure it's like true to the show, right? True to the time. And the only note I got from him was Walmart wasn't around back then, and I was like, okay. I was like, I don't know when Walmart was created, but sure, I'll take it. I'll I'll take the hit on that as long as everyone else enjoyed the right. So let's go back to SPX here. Yeah, Ray go long Walmart. We can certainly take a look at it after telling that story. But right now with the SPX, I mean, this thing is trying, right? The Normally, when you get to a big psychological level like this of 4,500, a lot of people look at that level and they're like, okay, it's definitely going to drop, right? It's a hard line of a psychological level. It can act as resistance. We haven't been back at this level since really early last year. And so when people see it, they almost become slight perma bears, thinking that we have to break back to the downside. But the clue about whether or not that's actually going to happen is, in my opinion, is to watch the smaller time frames. And if the smaller time frames aren't breaking, right, as momentum resets, which is what is happening, right? We After these strong moves to the upside, we reached exhaustion levels. We've been in the process of slowly resetting. And when that momentum resets, if the price isn't pulling back with the momentum, if we're not going down to fill these gaps, that's usually a really good sign that the price is holding this level, right? It's not immediately selling back off of it. Now, the like Turbo mentions, JP Morgan has earnings tomorrow. There are earnings coming up. So, of course, if those earnings come out negative, that could be the catalyst to have this drive back down. But currently, the market is doing a really good job of holding up at this level. We're really not breaking our support. We're just getting a bit more consolidation. And so when that consolidation happens, right, we have consolidating signals with the momentum resetting. We have consolidating signals on the compound breakout tool. Bollinger Bands are in consolidation. Our moving averages on like the 5-minute chart are starting to converge a bit more. All of that is usually means it's not uncommon for a squeeze to start to print. And we see a 5-minute squeeze and a 10-minute squeeze starting to form. And that's that energy getting built up. And so if we can continue to maintain our support levels as that energy builds, that could be a very good clue that it's trying to take the time to build up that energy to then break above 4,500 rather than to roll over. Now, of course, these squeezes could still end up firing to the downside, but the clue for that is starting to break support levels, right, on the smaller time frames. If we start to break those support levels, then yeah, there's a good chance we could get a reversal back into the hourly 10 period simple at 44.83, or maybe even a stronger reversal down to the ATR trailing stopper 30, right? That wouldn't certainly be out of the question. But right now, they're all holding these levels. So it makes me inclined to think that we're building energy to break 4,500. Now, I don't know if that's going to happen today necessarily. I could see overall us chopping in this range. And a part of that reason is because we've had 2 days now of gaps to the upside, basically. We've shown a lot of strength here. So because on the hourly chart, when we zoom out, there is still room on momentum to continue to the top of the axis. The bars are bullish. Technically, our compound breakout tool signal is still a valid bullish signal, and our Bollinger Bands are flaring open. All of that leads me to believe that we could just consolidate, allow the moving average to catch up with the price, very much like it did here. And if it maintains support, look for that potential bounce to follow through. And so right now, given how far the 10 is, it could be a very similar situation like yesterday where, we don't move much more. We just consolidate. The 10 catches up by the end of the close. And then tomorrow morning, right, especially if those earnings announcements that come out are positive, that could be the catalyst for maybe another bounce up at the open or a trend move following through into the end of the week. And so that's what I'd be just a little mindful of. I know Henry was in the options room earlier today. He mentioned he was on Twitter Spaces and he was, hearing these people in the financial Twitter community almost being bearish, like, oh my gosh, this thing has to reverse. And it's like, yes, right. A part of this could go back. Certainly, if you asked me earlier in the year, I had some signals I was watching on the quarterly chart that I was, anticipating for a bit more of a pullback move. But I also had a line in the sand, right? And that was back up 4,200. That was that weekly resistance. And this is exactly why, once again, controlling your risk is so important. If I was so gung ho on that signal on the quarterly chart, thinking that everything was going to fall down last quarter, and I loaded the boat on those trade ideas, it would have wiped out all of my profits and potentially my entire account, right? I could have ended up blowing out my account. But if you guys have been following along on those trades, or had heard me talk about this quarterly setup, I kept telling you guys, look, we're not loading the boat on this, because even though this quarterly signal has followed through every time in the past, there's always that possibility that this could be the one time it doesn't follow through. And that we can't take that chance of losing all of our hard earned money that we've built up to this point on one signal that may or may not work out. Even though it had, a good record of always working out in the past, it doesn't mean it's going to be 100%. The market will always do what it wants. And so I stress to you guys, one, the line in the sand is here at weekly resistance of the 100 period simple and ATR trailing stop. If we break that, that signal, in my opinion, isn't valid anymore, because that's showing that we're trying to go into a bullish trend. And what happened? We broke above it and we started to go into that bullish trend, bullish signal in the compound breakout tool, momentum still building up. All of that is valid. Our weekly bullish divergence bar from 2 weeks ago, that's followed through this week now with the higher high. And if I was so stuck in that mindset, I would still probably be trying to pile on shorts here, and they would be trading off hopium, right? Hoping that this thing turns around so that way I can say, haha, guys, I was right. We did get a pullback and I won. And that's not the way to trade. The way to trade is to follow the technicals that are in front of you. You're not trying to fight the market, you're trying to trade with the market. And then the second thing I stressed, I know whenever we talked about this setup last year and we talked about it this year, was that you can really set yourself up for small risk trades that have great profit potentials. That way, if it doesn't work out like it doesn't blow out your account. It was a very low end risk trade for a lot of the setups that I did when I was working off that bearish signal. I did a lot of things like broken wing debit butterflies, things that have very small risk. But if we did sell off, oh, that profit potential looked amazing. And then of course, it also built a forgiveness factor into the trade, because let's say it was volatile like we saw last year and it completely went past my strike levels. Well, on debit butterflies, right? Debit broken wing butterflies, if you go completely in the money on the trade, if you set them up accordingly, you still actually have profit potential if it does go completely in the money. And it's that forgiveness factor kind of built into the trade. And so we set those up, at the end of the first quarter to play into the second quarter, because that's how the signal worked. And unfortunately, right, there were a few times where you might have been able to take a quick win, depending on where you got in the fill, because we did have a couple pullbacks, but it was certainly not the stronger pullback that I was looking for. And so obviously for me, those trades did not work out. But is my account blown? Have I completely annihilated all the other profits I took this year? No, right? And that's because I had a good grasp on risk. And was I upset that we broke resistance? Yeah, right. I would have loved to see those trades work out, but I'm not emotional about it, because that was my line in the sand, right? That was my place to potentially cut the trades if, they still had good value on it. And even if they didn't, that's why you control your risk at the very start of a trade. So I'm kind of in agreement with Henry at this point. I don't, certainly we're getting closer to exhaustion levels on momentum. But the thing to point out here, because this is common with the indexes, is when we start to get into bullish trends, momentum sometimes on the indexes specifically, they can barely pull back, right? And that pullback usually means the price is either pulling back into a support or it's stalling. And then it pulls back enough to where it has room to do the next leg higher, right? And that's kind of what you saw a lot of in 2021, where we started to get to the top of the axis, it pulls back a little, we see maybe a little bit of a pullback into the next support, or we consolidate, and then it gives you enough room to boom, play the next run higher. And so even though we are starting to get closer to those exhaustion levels over here, I'd say we have like a couple more weeks until we hit the top of the axis. Doesn't mean that we're necessarily going to break out of this trend. It could just be we pause and then bounce up, or we get a little bit of a pullback into a moving average. But if that holds, look at that as a buying opportunity to then play back to the upside. So I'll be curious to see how we, continue to trade here at 4,500. I know there are, a few people out there that think 4,500 is kind of the bigger level that we'll stall at. To me, though, looking at the levels I did this morning on longer time frames, I think almost 4,600 is the bigger level of the two. So I wouldn't be too surprised if this actually tried to keep going up into 4,600 and then we started to stall a bit more around that range. When we notice the daily chart's pulled back enough to where it has room to move back to the top of the axis. You're getting a green bar kind of helping that confirmation. You're attempting a bullish signal on the compound breakout tool. We've broken that recent price resistance level at a 44.50 to 44.60 range. Bollinger Bands, of course, are starting to open back up. We had a low compression squeeze that printed for 2 days. That looks like it's attempting to fire now. And so all of that, along with the fact that our intraday charts, at least currently, are not giving up their support levels, is what leads me to believe that we could start to break above 4,500 and try a hand at getting into that 4,600 range. So we'll see whether or not that happens. But that's my bigger picture view right now on SPX. Let's go on. I want to make sure we look at some of these other things. So AI is the first one. Now this one's a little frustrating because as much as the market's up, AI is kind of just hanging out, right? For those of you who don't know, I do have a $500 challenge trade on currently in AI. The good news about this trade is we did give ourselves some time. So it's not like it's a this week short-term expiration. That was part of the reason I gave myself time, is because I was a little concerned about it not necessarily getting a nice stair step move up. It's been kind of a bit more gradual, I would say, on trying to move to the upside. And you can see that recently, right? It's kind of stalling. We're getting a bit of chop. And so we gave ourselves 2 weeks to try and get this move higher. The next thing we did is we chose strikes on a vertical spread to help reduce our risk. And our short strike on that vertical spread is at 45. This is the trade is in my Moomoo account, but just so you guys can see it a little bit easier, here's what the trade looks like in the $500 challenge account. So it's the 42.45 long call vertical spread. You can see 45 out 2 weeks does have a good amount of open interest on it. It's down a little bit at this point because of the chop, but if we do continue this bullish sentiment higher, even if all it is to go back up into price resistance and test the upper Bollinger Band, the top of the axis, well, that puts our spread in the money. And if it goes in the money, it should allow for a profit on the trade based off our cost basis. Whether that move happens tomorrow or whether that move happens 2 weeks from now, going into the expiration week. So what I'm looking for on this is, as long as it maintains the moving averages, I still overall like the trade. Momentum rolled, pulled back, right, to the zero line, never crossed below it, and is building up. So currently that's still bullish trend sentiment with room to move higher. We still have a valid bullish signal here. Now we are starting to get one red box, but as long as it's just the one red box, it won't cancel out the bullish signal. The only way it cancels out the bullish signal at this point is if it gives us a proper pullback signal, which means 2 or all 3 lines are showing that bearish sentiment, or it starts to print back to back. And when it starts to print back to back and kind of look like Christmas lights, that's another sign more of consolidation. So I'm not a fan of necessarily seeing the red box today, but it doesn't cancel out the signal. We also had a recent true low signal back here. And then we have a low compression squeeze. Surprisingly, that's kind of flipping off today. We'll see if that stays that way into the close. But ideally, we would want to see that low compression squeeze kind of give us a bit more energy to at least take us up into 45, if not maybe higher. So at this point, it's a bit more of a game of patience, and we'll see if it can continue to hold the quote unquote line in the sand that we have on this setup. The other thing I still like about this chart at the moment is the hourly chart still has a very nice squeeze that's been forming. So if we can get the hourly squeeze to start to fire to the upside, that should help with our catalyst for a move higher. There's that squeeze there. You can see still more consolidation on the compound breakout tool, unfortunately. Excuse me, consolidation on the awesome oscillator. When the bars, you can't even see them when they're like this, right? When they're basically hugging that zero line, it's more a sign of consolidation than anything else. Now, technically, we have crossed below the zero line, so there is a little bearish weight here. We want to be mindful of that. But I wouldn't necessarily count this as a bearish trend signal just yet. If it starts to pick up with bars moving lower, then yes, we need to be mindful that this could start to reverse on us and maybe break that daily support. But currently, even when we zoom in here, you can barely see the bars. That's more a sign of chop than anything. Not a fan that we've broken the moving averages on the 1 hour, but Bollinger Bands are still very flat. So that's good news for us. It means that they're not anticipating a break of this level, which is why they're holding. And if it can hold, then we get a follow through for a bounce back. Once again, towards the top side, that should at least on the hourly chart put us back by our long strike. And of course, if we get that bounce up into the daily price resistance, that will put our spread in the money. So that's what I'm seeing with AI and the narrative on that. So we'll keep a close eye on it. Of course, if I take any action, I will certainly let you guys know. But for right now, right, that seems to still be holding up. And that's why we built time into the trade to give ourselves a little bit of patience on it. So I appreciate that 007 versus strong. Yes, I like to think so. Let's go on to Walmart really quick. And then I do see JP Morgan. Absolutely. We can talk about an earnings lotto trade on that as well. So on Walmart here, we zoom in, it's also kind of in consolidation, more a bullish trend, right? The simple moving averages are still stacked up, but you can see momentum's resetting. We still have a valid pullback signal. A squeeze is building up that energy. Bollinger Bands are relatively flat. It does look like the lower Bollinger Band might be trying to open up a little, so I would be cautious about that. Our last two bearish divergent bars have followed through with lower lows based off this bar. But you can see we're basically consolidating in between the 10 and 30 period simple. And those bearish divergent bar signals, that they both did technically follow through, they're counter trend signals. So I personally wouldn't have played those too aggressively by any means. The question, of course, is now into the close, can we maintain the 30? Right? Even if it bounces back up and gives us a bullish divergent bar, unfortunately, back-to-back divergent bars are still a sign of chop overall. So if I were to choose a strategy to try and play here at this time, I would probably lean towards some sort of put credit spread or put unbalanced butterfly, with the idea that we continue to hold right around this 152-ish, 152, maybe a little bit below that 151 level, right where that ATR trailing stop and lower Bollinger Band are. You can see from the last mini run to the upside that we had here on the pullback, this has been the price level that's continued to hold as support. So if it can maintain doing that, then something that benefits both from chop as well as a bullish run back up would be the ideal strategy probably in this situation. And so I wouldn't look to play this aggressively yet. If we start to get a little bit more bullish sentiment here, the squeeze is still valid, then you might play it, go further out in time and play it directionally with like a long call. But currently you don't have any of that bullish sentiment or lower indicators yet. You're not necessarily above all your moving averages, right? You're at 30. And so because of the flat Bollinger Bands and things like that, I'd probably play the chop. And then, of course, if we bounce up towards the 10 and stall again, or maybe bounce up a little bit more into this 158 range and stall there, and you, for whatever reason, haven't taken your profits on the put credit spread, you could always then add on a call credit spread, as long as it's within the same expiration, as long as it's the same spread width, and as long as your short call is above, aka higher than your short put, it will actually be a capital positive move for the account. And what you would basically have happen is you've turned your trade into an iron condor. So the idea is you're collecting premium on both sides to play the consolidation. But I would not personally add the call side just yet. I would start with the put side and then see if you get the bounce back up. The reason why is if all of a sudden this does start to turn higher, you don't want the call side to all of a sudden work against you, right? So you're closer to support than price resistance at this point. Start with, the put side of a put credit spread and then build into the call credit spread if we get back up into the resistance and it stalls, is what I'd say to do. And then AMD, yeah, guys, let me write these down really quickly, as well as BTC. I can't spend too long technically the session is done with. I think today was timed out for a shorter session, but I don't think anyone's after me, so I'm happy to go a little bit longer today. Also, let me know if somebody is after me. I will jump out of their way. But let's go over JP Morgan now, AMD, and then we'll take a look at Bitcoin. So on JP Morgan here, nice run up into the earnings announcement, especially off this bullish divergent bar and pullback. There's still room on momentum higher. This is still a bullish signal. Our squeeze has started to fire. But of course, anything can happen around the earnings announcement. So let's take a look at how JP Morgan's acted on prior earnings. On this earnings, we had a nice gap to the upside and then trended higher the next few days. Of course, with it being a Thursday, if I was doing like a lotto earnings trade, I would only play it into tomorrow's expiration. So we really just want to look at the following day move. So here we gapped up, right? It's a pretty volatile move. Here on this earnings, we actually gapped lower and then shot to the upside. So the two strategies that I usually consider around earnings, both of those technically would have worked out at some point in the day, it looks like. Here we had a gap up, tried to trend higher, stalled at the 100, and then pulled back. So a little bit more of a volatile move, and then it came back down. And then here, off this earnings, we kind of gapped down, and then it reversed the next day. But once again, we're only looking for what happened on the overnight move in this case. So it was a bit more of a gap down. So it looks like the initial reaction on JP Morgan earnings usually causes a bit of volatility, right? It's less likely that it's just going to be a non-event. And so usually I look to trade earnings if I'm doing a lotto trade like this two different ways. The first way is if it is more a non-event, I look at an iron fly and I look for that crush of premium. So right now we're trading closer to 149. So I'd do that as my short strike. The anticipated range going into tomorrow's expiration, which of course encompasses earnings, is a little shy of $4. So let's go $4 out on one side, $4 out on the other. Oh, well, we only start to get 5-point strike increments. That's a little frustrating. So let's see. This is a 6-point range. So let's keep it even. Let's go to 6. On a 6-point iron fly, it's a 355 credit, 245 risk. So still not a bad risk versus reward, even though it's a bit further out than I'd prefer. And of course, the premium you receive is very close to what the anticipated range is. So the idea is if you really think JP Morgan is going to be a non-event, then you do something like this to let the premium crush work in your favor. And let's say it does move up or down $3. Well, the premium you've received is close to what they anticipate the range to be. So ideally, you'll still be around a break even, situation if it does get a little bit of a bounce up or down. That's the one way to consider playing it. But as we just walked through on the charts, it does look like JP Morgan is a little bit known to get those volatile moves. So if that's the case, usually I go out within the 4-point range. So 4 points higher would be right around 152.50. I don't know if this is going to price out well because of the different strike increments here, but let's just go ahead and test it. So in this case, because of the smaller strike increments, usually I'd look at something like a debit broken wing butterfly on each side. But in this case, I'd probably either just stick to 2 longs or 2 vertical spreads with the idea that one side or the other goes in the money. Or if it's like this earnings, right? Maybe one side you take the profit on at the open, and then you still have a chance to take a profit on the other side at the end of the day. And so let's see, it's about a 2.5 with spread. Let's just make it 3 points here. I mean, that's still not too bad. So that's about a 120 risk, a 181 profit potential. Now it's a little different, right? Technically on this side of the trade, because it's a 2.5 with spread rather than a 3-point spread, your profit potential, if it bounces up and goes completely in the money, would only be a 130 credit. Now that's still over 100% return. The 180 max profit potential comes on if it gaps to the downside. Um, and so you can see here it's roughly within that anticipated range. You might actually go up a contract if you're able to. Yeah, that's still not a bad risk versus reward. That way you encompass the 4-point move a little bit more if it goes in the money. 145, that would be at least a pullback into the 10, if not maybe a stronger drop. And of course, a bounce up, a gap up, that would be near the upper Bollinger Band. That wouldn't be out of the question for how JP Morgan's moved in the past. You could, of course, also just look at going with a long on each side, but that, of course, increases your risk. Unlimited profit potential, certainly on the call side, and a big profit potential on the put side if it really dumped. But the thing I'm not a fan of about doing that on this earnings specifically is because it's a Thursday and we're using Friday's expiration. So if it's a non-event, or let's say it does bounce, but maybe it stalls at your long strike of 146, 150, theta decay is going to wipe out the value on these trades. So even if it goes at or maybe a tiny bit in the money, because your cost basis is 248, right? It's a little rich. You almost want it to go in a bigger move, so that way your long strike when it goes in the money at least is in the money by about 250, if not greater, to allow for that profit. So personally, I'd probably stick with the vertical spreads. It's a bit more within my risk tolerance, and kind of look at it that way. If I were to play JP Morgan's earnings, which I'm personally not going to. So for just to round out this earnings talk here, I have found in the past I get a little trigger happy, if you will, doing earnings trades. At least I certainly have in the past. And I noticed though on the P&L going through all those trades, because they're certainly unknown, right? We have no idea, unless you have the insider scoop, you have no idea how the market's actually going to react to the announcement, to the forecast, did they hit targets? And so it's one of those trades where I really consider it a lotto trade, which means one, I'm always looking to do a smaller capital risk than my normal risk tolerance, and I have to be okay losing 100% of that capital. Now, that being said, probably outside of the first quarter of this year, it's like 50-50 on those earnings trades. And so I found whenever I put on too many, my winners didn't necessarily outweigh my losers, right? It was kind of like a flat situation. And so because I kept track of that in my trading journal, what I do now on earnings seasons is I usually only pick maybe a handful or just a couple, right? Like 2 or 3 earnings to trade. And so usually I'm not going to pick something like JP Morgan. I'll play like a Tesla earnings, right? Or I'll play something else that has a little bit more oomph and probability to getting a gap move. Now, that being said, if you were following along with me on earnings trades earlier this year, the first quarter, I did a lot more earnings trades than I normally do, but that's because there was a really clean technical setup. Basically, a lot of the earnings in the first quarter of this year saw strong volatile gaps to the upside, especially if it had a valid bullish divergent bar prior to the announcement. And part of the reason that happened is because a lot of those symbols got beaten up last year, right? They had huge pullbacks, and then it almost became like a buying opportunity to play for a run up into earnings. And as long as the earnings didn't completely fail, right? As long as there was some sort of, oh yeah, we made target, right? Or our outlook isn't too horrible, then they usually had a strong gap move to the upside because everyone was happy to hear that they at least made target. Certainly if they beat target, it would cause a stronger move. And so the first quarter of this year, I did do, probably a lot more earnings trades than I normally have done in the past. But that was a special circumstance of a situation. At this point, though, now that we're, in our third earnings season of the year, I'm going back to just doing maybe a handful. And then David is asking, so you know how when a company has earnings, it typically opens a lot higher or a lot lower. Are straddles something you do recommend, or is that something not as consistent and reliable? So the issue that I have with straight straddles, right, with just a long collar, is you have to remember you're not the only one that knows that earnings are potentially volatile with those gap moves. Market makers know that too, right? And so what happens is going into an earnings announcement, that expiration that happens right after it occurs, and this would still be that one technically if this is tomorrow morning or yeah, tomorrow morning before market open, is that they build in a lot of options premium because it's due to that uncertainty of a gap move. And so that's why when it's a non-event earnings and it doesn't really do anything, you get that strong crush and premium. So usually if I'm looking to play more the volatile direction, I look at strategies like debit broken wing butterflies, which doesn't really make sense on JP Morgan, but let me just show you how it prices out, right? So instead of paying a whole $1.58 for the trade idea, I pay just a portion of that cost, so it helps reduce that risk, but then at the same time gives me strike levels that I think could potentially hit on a volatile move. And of course, if it's a really strong volatile move and my entire butterfly goes in the money, the debit broken wing butterfly still allows for that forgiveness factor of a profit. In this case, this is a 2.5 debit broken wing butterfly. So if it went completely in the money, it would settle still for $2.50. That minus 193 would still be a little over $1.50 of profit, right? So not a bad risk versus reward on either side. So personally, if I play the volatile move, it's not common that I'll just do the long call or put. I'll look for strategies that I can still play directionally, like those vertical debit spreads or the broken debit broken wing butterflies. That way I help control the risk a bit more and reduce it, but then still give myself a chance to play the move. Um, the only time I'll usually go with a long call or put is, arguably you may consider on JP Morgan, but it's usually when it's something like this where there are dollar strike increments, it's kind of priced a bit lower. And so that risk of a long call or put is still well within my risk tolerance that I look for. So I hope that makes sense, David. Um, but that's the thing to be mindful of, certainly. And so that's it. So for JP Morgan, even on that one though, I'd personally, guys, probably lean towards the two verticals if I were playing that into tomorrow. And then AMD, let me pull that up and then we'll do Bitcoin last. Exactly, SR. So on AMD here, I don't see a squeeze. Did we say that in a daily squeeze? I don't see a daily squeeze. Maybe if you have overnight that prints, right? If you print the futures data and the overnight data, then that might change things. I don't technically track that on my charts. So maybe that's why a squeeze isn't popping up here. Um, but in regards to where I think which way this is going to go, it's a little too soon to say. The 10 period simples in between the 30 and the 100. The Bollinger Bands are still converging. Momentum is pulling back towards the zero line, but because it's below it, that adds bearish weight to it. On the flip side, we're trying to get a bullish pullback signal. So if we break above the 30 period simple and this is still valid, that's a good clue. We could go into the ATR trailing stop. So it's really, from everything I see here, it's kind of a mixed bag of consolidation. Now, the true low signal that printed recently would lead me to believe that it's going to be a bounce to the upside, right? Last time we were kind of in a choppy mess like this and we got the true low. We ended up getting that trend higher and the follow through that you normally look for off that signal. And for those of you who don't know, the true low signal is supposed to help identify like the discount price. But let's take a look at the weekly because the clue sometimes is what is the weekly doing. So the weekly, we're not at exhaustion levels yet, but we are pulling back. We have a pullback signal here. The good news though, for if you're trying to play this bullish, is we're not breaking the 10 period simple. We're just kind of consolidating there. Back-to-back divergent bars are a sign of consolidation. I'd say if this makes a bullish divergent bar into the end of the week, I'd be more inclined to play it to the upside. But I don't have really any other bullish signals. The trend still technically isn't bullish because the 30 is below the 100 while the 10 is above it. But I do like how it's holding support. So I would be leaning towards the upside. But I don't see any sort of, personally, I don't see any sort of trigger to pull and jump into something myself for a long call. And trust me, I am looking for trades. I was doing quite a few scans this morning because stuff I had on my short list this week that I didn't jump into seems to be all the things that are taking off, like Shopify. If you guys were listening to me earlier in the week, I liked that one. And for whatever reason, I decided AI was the one to jump into instead. And Shopify just is knocking it out of the park for that quick run up. Unfortunately, AI is not following along that way, but that's okay. Let's take a look at Bitcoin here. And that will definitely be my time. I'll have to step out after this. Gotta take my son to speech. So Bitcoin, nice hold of the 10. Basically was consolidating there, bounced up. It is running into price resistance. Always kind of need to be mindful of that, which is basically right at the 31,500, 31,500. You are canceling out of the pullback signal, so that's pretty good for bulls. But Bollinger Bands are still a bit more in consolidation. This is still pulling back now. I don't know if this is necessarily not a bad place to buy in, only because everything about this is still more bullish, right? And it's holding that first line in the sand. But I'm never a fan of buying anything at price resistance. So I would have either preferred to buy back here on the pullback, or even though it means I'm paying a little bit more, I'd like confirmation it's breaking this price resistance to then play for the next trend move. So to me, overall, it still kind of looks like it's stuck in chop and it's at the top of the range. But if I were to choose which way I think it's going to break out of the chop, I'd play it to the upside. It's done a really good job of holding up overall. Especially now that BlackRock is deciding to finally jump in the game. That's definitely a clue. If you guys recall, I'm pretty sure they were one of the people who used to bash Bitcoin, right? And now that they were able to get in at a discount price like the rest of the world, they're like, oh, no, 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 it's fine. Gotta love it. The 100 period simple, that's probably part of the issue with your consolidation here. So you do have some of the bullish signals. You did have actually recent true lows back here. That would have been a good place to jump in at around 26,000 to play for this run higher. But it makes sense why you're consolidating. So once again, you might wait for confirmation that it's actually going to start breaking the 100, because certainly if it holds that and pulls back again, you'll be able to get in at a better price. But if it starts to break the 100, you at least get the confirmation that, the trend is still going to the upside. So that's what I'm looking at there. And that is my time today, guys. So thank you so much for joining me. Rob, if there's a beach nearby, I would be doing beach therapy. I got a pool in the backyard, though, so that's what helps me de-stress after a long day or week with the kids. So, oh, and then LCU, I just saw your thing. Yeah, we can check hood really quick. I'll pull it up here. And this will be the last one. It's like a splash week at speech, so I know my son will be mad if we miss it. They get to like play outside today. So hood, wow, great run up. I haven't been paying attention to this one. You had some recent true lows back here whenever the Bollinger Bands were flat. So that was your good discount price buy-in. And you can see that certainly was a great place to do so. Even if you wanted to wait for a bit more of a bullish confirmation, here was a pretty good spot, right? You had the bullish signal starting to print on the compound breakout tool. You had the squeeze, you had the rising momentum with room to the upside. You had a bullish divergent bar entry off support. All of that led to a nice run higher. At this point, if you're not in this, you're late to the game. It's not a place for me personally to buy, because if you're buying here, it's a case of FOMO. You're mad that you missed out and you're being emotional about the entry here. And usually when that happens, that's, the place people are taking profits and cutting. Also notice you're at the top of the axis, so that's a sign that we could be starting to reach exhaustion. Notice that you're also back at the price level that it was here, so this could start to act as price resistance. If you've already taken profits and you're playing a runner, by all means, keep playing the runner and just adjust your stop loss higher. But if you're looking at this for a new trade, it's not a place for me to jump in. Even if it continued higher, it's like great, but it's from a technical standpoint, back here was the better entry for this, or even here was the better entry, not way up here, because there's so much room that this could pull back into support. The one thing I would say that helps kind of the bulls out is earnings is still a little ways away. So this could continue to run up into earnings. But if you tied my hands behind my back and really forced me to trade this, I would once again either have to wait for a pullback or confirmation it's breaking this price level. And if it was the second, right, it's breaking the price level, I would only do a fraction of my normal capital risk. So if my normal risk per trade is 500, I'm barely probably doing 100. And the reason why is because if it goes to the upside, great, you have a little bit of capital in the game to play it. But if it pulls back and holds support, then you can build into your normal risk tolerance at a much better technical level, right? You can add the additional 400 there and you have a much better cost basis. And then of course the third thing that could happen is if it pulls back and breaks, you'll be very happy that you're only managing $100 versus a full $500 of your normal risk in your account. So that's what I'd say about Hood. It's a beautiful move. Wish I was paying attention to it myself. But, as a trader, we can't trade everything, and that's okay. If you miss something, just keep looking for the next setup. That is my time, guys, though. Thank you so much for joining me. As always, may the trade be with you, Jane. I'm jealous. Have fun with your beach therapy. And I look forward to talking to y'all next time. Bye, guys.